Well, we're officially off to the races, and stocks we had seen were set to open fractionally lower. We've seen volatility in the precious metals space. Of course, that did emanate or pick up, if you will, after President Donald Trump announced his pick for the new Fed chair on Friday. Joining me now to talk markets is Eddie Gabor. He's co-founder and CEO of Key Advisors Wealth Management. Eddie, great to have you on the show this morning. And let's start with where we stand. Just a fractional loss for the S&P 500, down about 0.3%, still about 1% from its all-time high. What's behind these moves?
You know, I think last week, let's not forget, we were at all-time highs in the S&P last Thursday or last Wednesday. And I think this nomination of Kevin Warsh just scared the market because in the past, he's talked about reducing the balance sheet of the Fed, not a real fan of QE. And I believe, like the markets always do initially, is overreact to the downside. I think at the end of the day, Kevin Warsh will look at the data. And if the data supports to stay dovish and loosen monetary policy, I think that he will. I think there's a high probability that inflation actually decelerates over the next few months, which is not consensus. So that will give him and the current Fed the opportunity to actually stay dovish. So I look at this as a buying opportunity in the economically sensitive areas because I think the market is really overreacting. He's not even in there yet, and the market's trying to price in what his policy will look like. And that's a little premature, in my opinion.
Okay. And in terms of these economic sensitive sectors, Eddie, walk us through some of those areas that stand out to you.
So we've been rotating out of tech and going into areas like financials, industrials, small caps, and housing. Those are the areas that we like. We think those areas will do well because we are looking at this economy as growth accelerating over the next few months. I think the growth is going to exceed expectations, and those areas are really outperforming tech and S&P when you look at it. And I think it's because they're telling you that the economy is going to surprise to the upside. So I would take any weakness in those areas for the right risk tolerance to add, as we have for our clients.
What a consolidation, if you will. I mean, again, the S&P 500, it's a pullback, but down just about 1% from its all-time high. Is that healthy at this stage in the game based on where markets are?
I think volatility is healthy as long as it's controlled. What we don't like to see is like what we saw with the metals or like with crypto, these huge moves. When you have that type of volatility and the volatility index spikes as high as it does in those sectors, that's a problem. But in the broad market, VIX is having a hard time getting over 19 to 20. So as long as it stays under 20, it's a good place to be. So volatility is to be expected in this type of environment. But overall, the broad market is holding up just fine. The panic attack areas are in the areas that have had the most speculation this month.
Walk us through the volatility that we see in the precious metal space and why, Eddie, we are seeing that there seems to be a correlation with stocks, that some of the weakness or pullback, if you will, in precious metals is impacting the major indices.
Well, when you take a look at gold, for example, it has had an amazing run. So unless you bought real late, this correction that you've had in gold should not have hurt your overall performance as a whole. It's done amazing. I think the problem is it got really crowded and you saw people really start to speculate and leverage up. That's why you saw that real vertical move before you had the big drop. But I think the drop in that is because, again, the market reacting to Warsh and maybe having the dollar get really strong under his leadership, and the commodities market just needed one news to cause a big sell-off because it was so crowded. I do think things will stabilize in that market and potentially could be an opportunity to start dollar cost averaging back in for those that have not benefited from the gold trade.
Okay, so it sounds like you are still bullish on gold despite some of the volatility. Eddie, is that the case?
That is the case. We still own gold for clients. We did trim. I tweeted it out. I believe it was last Wednesday that we actually trimmed some gold. But with this big sell-off we had in such a short period of time, we will be buying back gold. We think the story is still intact for gold. And again, we're going to let Kevin Warsh see what he does, but we think he's going to be more dovish than the market's currently pricing in.
What should our viewers be following when it comes to the 10-year Treasury yield, Eddie, and the U.S. dollar as it pertains to their portfolio?
To us, the 10-year Treasury is the biggest risk to the equity markets. If we start to get towards that 4.75% range in the 10-year because of an acceleration of inflation, that's going to be a real problem. We don't think that's not a concern for us here, intermediate, over the next several months. But we want to look at that. And of course, the dollar, if the dollar gets really bullish and strengthens quite a bit, that's going to hurt the equity markets as well, too. We think technology is going to struggle regardless, which is why we are rotating out, and we will sell any strength in the month of February in technology. But right now, we keep a close eye on rates and the dollar, but it's not an immediate concern for us. So we think this panic attack is a buying opportunity.
Eddie Gabor, co-founder and CEO at Key Advisors Wealth Management. Eddie, thanks so much for joining.
Thanks for having me.